Welcome back to Navigating Estate Planning with Caress Law. We hope you're enjoying the show. Before we dive into today's topic, we have a quick request for you, our listeners. If you're enjoying the podcast and finding value in the content we're providing, we would greatly appreciate it if you could take a moment and support us by leaving a 5-star review on Google. This review helps us reach more people who might benefit from the information and insights we share here on the show. Plus, it lets us know what you like and how we can continue to improve. So if you're finding our podcast helpful and informative, please take a moment to give a 5-star review on Google. It only takes a minute, but it makes a huge difference for us. And also, don't forget to leave a comment too. We love hearing from our listeners, and your feedback helps us shape future episodes. So please help us spread the word and get the conversation going. Thank you so much for your support. Today, we are going to talk about advanced estate planning strategies. You'll learn a little bit about the estate taxes and also some strategies that you can implement now to reduce that overall estate tax and pass more wealth to your loved ones. I'm your host, Tammi Caress, founder of Caress Law, and I'm excited to bring this material to you today. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. So we're going to talk about estate and gift taxes. Most of you, if you've listened to my prior podcasts, know that there are lots of different taxes. There's the income tax, which we have to file annually when you make a certain amount of income. And then there is the estate tax. The estate tax is a death tax. It's a tax assessed at death on estates that reach the thresholds for taxation. So it depends on where you live and also how much wealth you have or you own right before you pass. For example, the federal estate tax today, this is a moving target, by the way, the federal estate tax is assessed on estates that are valued at more, it's $3.61 million today. So if they're valued at $3.61 million or more when a person passes, then there is a federal estate tax, and an estate tax return needs to be prepared when a person passes, and then possibly there is estate tax due. So what is an estate tax? Or how do we determine if a person reaches the threshold for estate taxation, I should say? What we do is when a person passes, that day that they pass away, we have to look at their entire estate. And I have a previous episode on what an estate is, so please go back and listen to that. But essentially, we take all the assets that person owns and we value it. And if it meets the threshold for the federal level or the state level, then we have to file an estate tax return and potentially pay estate taxes. In Oregon, the threshold is $1 million. It's pretty low, and it's a significant difference from the threshold for the federal level. So federal is $13.61 million federally to be subject to the estate tax at death. And then Oregon is $1 million. This is per person, by the way. And for Washington, it is $2.193 million. If I refer back to it today, I'm just going to say 2.2, although it really is a little under 2.2. It's just a little easier to talk about 2.2, then 2.193. Anyhow, so those are the estate taxes, but there's another tax called the gift tax. Now, gift taxes do work side by side, if you will, with the estate tax. Now, in Oregon and Washington, good news, there's no gift taxes. So you don't have to worry when you gift someone assets during your lifetime. Say you give someone $20,000, or maybe you're helping a loved one with a down payment on a home and you gift them that down payment. In the states of Oregon and Washington, there's no tax assessed or no reporting requirement for those types of gifts. On the federal level, it's different. Federal gift taxes are reportable. They're reportable gifts. And ultimately, if you gift more than the gift tax amount or exclusion amount, then ultimately there are gift taxes when you transfer wealth. So on the federal level, how the gift taxes are tied to the estate taxes is that if any person makes a gift of over $18,000 during any 1 year period, that person who makes the gift has to file a federal gift tax return. Now, the good news is in order to actually be assessed a tax on that gift on the federal level, a person right now has to gift more than $13.61 million during their lifetime. So the gift tax on the federal level isn't super impactful in terms of a payment of a gift on many estates right now. However, it's still a reportable requirement if you gift more than $18,000 to a person in any given year. So you have to recognize that the gift tax return has to be filed. And the way this impacts or ties with the estate is anytime you make a gift of over $18,000, you report it to the IRS, your estate tax exclusion amount, which is the amount that can pass tax-free at death for estate taxes, is reduced by the reportable gift. So an example is you have a $13.61 million exclusion for estate taxes. So your estates can pass that amount of money when you die without being subject to an estate tax. If during your lifetime you gave a loved one a $200,000 gift, maybe to, put a down payment on a home, well, your $13.61 million estate tax exclusion is now $13.41 million. So that gift during your lifetime reduces the estate tax exclusion amount. Okay, so I hope that makes sense. So that's how they're tied. And it's kind of important to know so that you have a basis a little bit of what I'm talking about today. So today we are talking about some advanced estate planning techniques that you can do. Now, all of these techniques I think can be good techniques, but just remember every situation is different. So it's super important to talk with your attorney about some of these techniques. And even when you have a financial advisor, talk to your financial advisor. And wouldn't it be really great if you talk to both of them at the same time? That would be wonderful. Highly recommend it. Also, your CPA, that's kind of the third party you can talk to. And if you can get everyone in the same room together or on the same call or Zoom, even better, so that everyone can give their input and their perspective. So, tax-free gifts versus taxable gifts. This is the first estate planning or advanced estate planning strategy that it's very simple to implement. Essentially, today, as of the date of this podcast, a person can make a tax-free gift to any individual of $18,000. Notice I said individual, okay? It has to be to a person. So in any given year, you can basically write a check to someone for up to $18,000. You do not have to file a gift tax return, and it's not a reportable gift, and it's not going to reduce your estate tax exemption amount. It's a tax-free gift. So you can imagine if you do this over time, say you have nieces or nephews grandnieces or nephews, children, grandchildren, you can write an $18,000 check to each person during that year. And collectively during that year, you could have made some really great tax-free gifts. And when you pass, those assets that you gifted are not in your estate. So they're not going to be subject to the estate tax. So it's a really great way to start passing wealth to younger generations, removing wealth from your estate so that you're minimizing the overall estate tax burden. The other thing that you can do is pay for tuition and medical expenses. Now, I know a lot of people who do support typically grandchildren who are going to college, and they might help pay for that tuition. Well, the best thing that you can do is pay the tuition directly to the institution so that it is a tax-free gift. So if that tuition is $50,000 and you're paying it for your loved one, a couple generations down from you, pay it directly to the institution. That's a tax-free gift. You don't have to file a gift tax return, and it doesn't reduce your estate tax exemption amount. Now, if you wrote a check to that loved one for 50 grand and with the intention that they're going to use that to go pay the tuition, you have now made a taxable gift. So see the difference? Pay the institution directly. Same thing for medical expenses. Pay those expenses directly to the provider, not to the individual. But a really great tool that you can use to start passing wealth and also minimizing your estate value. The other is charitable contributions and charitable trust. So during your lifetime, if you make a contribution to a charitable organization, then a qualified charitable organization, then you can use that as a tax deduction on your income tax return. Remember, there's lots of different taxes. So we're talking about income tax return here. If you plan to make a gift to a charitable organization through your estate planning, and that gift is made after you're gone because your will or trust said to make that gift, that actually is a deduction on your estate tax return. So that's another way to reduce the overall estate tax burden, is to directly through your estate plan make a gift to a charitable organization. Other things that you can do is creating charitable trust. Now, charitable trust, this is a really great tool if you have an asset that has a very low cost basis and you were to sell that asset and you're going to get stuck with a lot of capital gains. I see this a lot with my older clients who might own some apartment buildings, for example, and they just don't want to deal with it anymore and they're ready to sell those buildings, but they've had them forever. Then if they're charitably motivated, what they can do is create a charitable trust. They can put that apartment building inside that charitable trust. So charitable trust is now the owner. The charity will receive that asset when let me back up. We put that property in the charitable trust, that the trustee of that trust can sell that property. And guess what? There's no capital gains tax when the property is sold. The sales proceeds go in the trust, and you, as the person who made this trust and contributed the asset to it, can take an income stream out for your lifetime. Or you could also, instead of taking an income stream out for your lifetime, give an income stream to somebody else for their lifetime or for a term of years. Okay, so what happened here is they've avoided the capital gains tax, and now they're getting an income stream for this property. And then guess what? When they pass, or when the term of years, because you could say, let's set up this trust for 5 years or 20 years, whatever it is. But when that term ends, whatever's remaining in that charitable remainder trust will go to the charitable organization of your choice. So that's a really great tool to minimize capital gains tax, to create an income stream for yourself or loved ones, and then ultimately to benefit charity, and just the cherry on top. When you do this, you actually do receive a charitable deduction on your income tax return if you do it during your lifetime. So it can also reduce your tax burden. So that's a wonderful gift. And those people who are charitably motivated and have those type of low basis assets, and it's just going to kill them if they sell it in taxes, this is a way to benefit from it. This can also happen with like a low stock, for example. And I've had this happen so many times where someone comes in with an actual stock certificate and it's from like the 1940s or something like that. And they say, yeah, my great grandfather had this and it's been passed down. Anyway, there could be a low basis stock. That stock is appreciated quite a bit. And if we sold it, there's going to be a high income tax. And we want to avoid that. So charitable contributions, charitable trusts can actually do that as well. Gifts to irrevocable trusts. Now, I have a podcast on the difference between revocable and irrevocable trusts. So please go back and listen to that if you want more information on irrevocable trust. But this is a very good way to remove assets from your estate. So therefore, when you pass, it is not subject to estate taxes because your state does not own it. And also get assets to a trust and ensure that those assets are managed according to your wishes for your trust beneficiaries. An example could be maybe you want to set up an irrevocable trust to support the education of the, couple generations down from you. And so you create this trust, you put money into it, and you specify how the money can be used. What a great thing, right? And it's a great legacy that you can pass on too. So you're help supporting some family members and loved ones achieve their educational goals. You're also able to ensure that that's how the assets are used, and you're creating a legacy because you did all this. So I think it's a really wonderful tool, and you removed it from your estate. So there's no taxes, no estate taxes assessed on that money. The other trust is an irrevocable life insurance trust. Many people are super surprised to learn that proceeds from life insurance policies are considered a part of your estate when you pass, and therefore they are included in the estate tax for taxation. So I have a lot of clients who have a $1 or $2 million policy on their lives, and it's a good thing to have typically, but if they pass, that $1 or $2 million policy is included in the gross estate and subject to estate taxes potentially. So one thing that you can do is you can transfer that policy to an irrevocable life insurance trust. And when you do that, you are no longer the owner of that policy. So therefore, when you pass, that policy is no longer included in your estate. And you can transfer that wealth to your loved ones free of estate taxes. Also, it creates wealth so that if there is an estate tax, there's cash available to actually pay it. So it can be a really great tool to pay for an estate tax. And a good example is a family who has multiple acres of land. Maybe it's family farmland that they want to keep in the family, and they are land rich, cash poor. If you have a life insurance policy set up in this way, that's going to generate some cash to make sure that the estate taxes assessed on that land at death are paid, and you're not forcing your loved ones to sell that land that's been in your family for so many generations in order to pay the estate tax. So that's a really great tool. It's also just a great tool to use to pass wealth on to your younger generations. Life insurance is a really great tool to be able to do that. And if that is the goal, putting it into a life insurance trust to avoid it from being taxed at your death is optimal. Okay. Another is a qualified personal residence trust. It's basically a trust where you transfer real property into it. Basically, on that transfer, you're gifting it to family members, but you're retaining an interest in that property for a specified term. And if you do that and you surpass the term, then that property will pass to your loved ones and not be included in your estate to be available for estate taxation. It also minimizes the gift taxes because you're taking an income interest out. You can gift the entire property, but you are not reporting the whole value. You're just reporting the fractional value of the gift. And I can speak more to that if you want to talk to me personally about it. But basically, it minimizes this gift and estate taxes, this type of trust. Another irrevocable trust is called a grantor retained annuity trust or a grantor retained unitrust. Essentially, it is once again similar to a charitable trust. It's a way to put money into a trust, receive an income interest for a specific term, and then the assets will be excluded from your estate and passed to your loved ones. There's no capital gains avoidance with the GRATs and GRETs like the charitable trust, but it works in the same way in that you're passing assets, you're getting assets out of your estate, ultimately passing them to your loved ones, but you're receiving an income interest when you do that. And last but not least, we have the family limited partnership. Now, this is, I'm going to say, a lot of times I'm going to use the word FLP. I'm talking about family limited partnership. This also could be an LLC, a limited liability company. I'm going to probably use FLP throughout the rest of the conversation on this subtopic, but just know it kind of works in the same way. So basically, let's just say that you have, I'm going to use land because I think it just makes it easier. Say you have family land, you have acres and acres of family land. It's all in your name. And maybe there is a business on the land. Maybe it is a farm, maybe it's a tree farm or whatever it may be. And you have family members who are kind of working as employees. Well, one thing that you could do is you could actually say, well, let's create an FLP and put the land inside of it, the business inside of it. And I'm going to go ahead and give an ownership interest in this FLP to my family. And my family who's working in the business, my other family who would, you want to make sure they receive their equal share. Maybe they're not working in the business, but you can give them an interest in the land through this FLP. And so what it does, what the people who've given this interest to, you keep some yourself, but they're minority interest owners. And so what happens is when we value the business as a whole or the FLP as a whole, there actually can be a discounted value applied because of the minority interest ownership in the business. And that's just to say, if you have an outside buyer who is not a family member or is not close-knit within this business, and they're coming in and they're buying a minority interest, so they don't have as many rights because they're a minority interest owner, it actually can decrease the value of that particular interest. So what happens is when a person dies and they have a minority interest in a business or an FLP, we value the asset, the FLP, and then we take the minority interest and it probably gets a discounted value because no person is going to pay full price for this full price of the business as a whole for just this tiny little minority slice, if you will. So it's a way that when you pass, if you own a minority interest because you've gifted some out, the value of that land, let's say that you had, your interest in the land is now a minority interest. The value has decreased, can be discounted. And so when you go and file your tax returns, you apply this discounted value, and then you're paying less in estate taxes. So the idea is, you get an appraisal, if you will, or you get a valuation of the business, which would include the land. This is the value of the whole thing. And we wouldn't just say, okay, well, you own a 49% interest in this business. So you take 49% of the total fair market value and that's the value. No, you actually discount that 49% interest or value even further because of the minority interest. So I hope it's a lot, but if the circumstances fit and it makes sense, it is actually really, really great estate planning tool to try to minimize your estate by one, removing assets from your estate during your lifetime, and two, reducing the value that's actually subject to tax on your death because of those minority discounts. The other good thing too is, say you own this land and you're going to do this, well, you can be the manager or the general partner, if you will. So you have pretty much the control over the business or the land, but you don't own the entire thing. And then you get a discount when you pass. So if the situation is right and the circumstances fit and it makes sense, it can be a really good tool. There is some case law out there that's bad, terrible facts. So we just want to make sure, we do it in the right way. This is not something I ever suggest you do by yourself. You really need the help of an attorney who knows this stuff and can actually make sure you're doing it right and not running afoul of any of those bad cases that are out there. In any event, that concludes our episode today. I'm Tammi Caress, and you've been listening to Navigating Estate Planning with Caress Law. I hope you have enjoyed the episode. Please don't forget to subscribe if these episodes are helpful to you, or share it with a friend or family or loved one if you think they can benefit from the episode. And as always, I would love to hear from you. Your feedback on the content is important, and I would love to better support our listeners and talk about some things that are interesting to you. So remember, estate planning is a journey, not just a destination. So keep exploring, keep learning, keep taking proactive steps to safeguard your assets and secure your legacy. Hope to see you next time.